Hello guys, welcome back to another video. So in today's video we'll be doing investment in a form of insurance. Don't forget to like, comment and subscribe to the channel. And if you are in need of a tutor, someone to help you, Zain Tutors has WhatsApp classes. You pay 300 Rand per month. We assist in mathematics, business studies, physical sciences and economics. You get exclusive videos, notes, question paper, and nice and coolest thing about it is that you can ask a question if you do not understand anything. Specific attention or special attention will be given to you to assist you in order for you to understand your work. So check that out. Send an email, WhatsApp or call. But if you cannot afford this, then we'll meet all the time here on YouTube. Please don't forget to like, comment and subscribe. When you like this video, I'll be encouraged to do more of this type of videos and I'll be able to do the next chapter. So please like this video so that I can continue to do this series. By you liking this video shows that you like this type of content, so I will do it more. So what you know that an insurance is an agreement between an insured between insured and insurer for a specific for a premium specified. So insured is the person who goes and get the insurance. The insurer is the person who sells the insurance. So insurance, there are compulsory insurance and non-compulsory insurance. So compulsory ones are enforced by law, like UIF, RAF and COIDA. You did acts, so you know, compensation for occupational injuries and diseases act, which is COIDA, and then RAF is the road accident fund, UIF is unemployment insurance fund, and then the non-compulsory ones are short term, where we talk about houses, insuring your house, your car, your bag, jewelries and so forth. And then long term are things that will certainly happen, like death. Okay, that is what we call short-term insurance and long-term assurance. So assurance is things that will definitely happen. Insurance is things that will possibly happen. Okay, and then we are going to talk about key concepts. You need to know these key concepts: insurance contract, the insurer, the insured, indemnity, risks, premium, life insurance, insurable interest, road accident fund, unemployment insurance fund, compensation for occupational injuries and diseases. So you can pause the video, study those. And then you need to know insurance. When you outline the concept insurance, you need to say insurance refers to the cover for a specific insurance refers to cover for a possible event that may cause a specific loss or damage. An agreement is an agreement whereby the insurer undertakes to indemnify the insured in the event of a specific loss or damage. And then you say the insured must pay a premium for specific losses or damage covered. And then a contract between a person, business, insured, requiring insurance cover, and the insurance company, which is the insurer bearing the financial risks. So if they say outline or explain, this is how you put it. You look at the marks. If it's 4 marks, give 2 full points. Those are 2 full marks. You will get your full 4 marks. If it's 8, then you write all the points. And then we have non-compulsory insurance, as I have said, as I have told you. That is the one that you voluntarily do. Okay, it's not, you're not binded by law to do this type of insurance. Let's talk about insurable concepts. We have over insurance and under insurance. Over insurance is that you have insured the value of something. You have insured something for little money. Okay, let's say you had something. When you insured it, its value was 5,000. Now, maybe that was in 2020. Now, when you go and claim, the value of that thing is now 10,000. But the insurance company is going to give you 5,000. You see? So you were no, in this instant is that you were under insured, right? because you now the value of that item that you are insured for, it's now less. So over insurance is when the item is insured for more than the actual market value. Yes, it's a car. You bought the car for 250,000. Now the car is worth 100,000. And then when you go and claim the 200,000, they say, no, we are not going to pay you 200,000, but you were paying the premiums for 200,000. And now they say you would only give you 100,000. That means you over insured your car. And they say if you have insured a car, you need to always be going back to your insurer to making sure that the value of the car matches your premium. Okay, businesses will not receive a payout larger than the value of the loss at market value. So this means that the extra money paid for the premiums will not be paid out to the insurer if there is a claim or loss. The insurance company will not say anything to you, but you have to go and check. And then the under insurance is the one that I talked about. The property asset is insured for less than the actual value of the property or asset. It was 5,000, now it's 10,000 rent, and you are only insured for 5,000. You see, so you were under insured. And then we have average clause. This is a stipulation set by the insurer, which is applicable when property goods is under insured for less than its market value. So the insurer will pay for insured losses damage in proportion to the insured value. This means that the insured is responsible for part of the risk that is not insured. So they will only pay a certain average. Okay, that is the average clause. Or we will only pay if the item, like you bought an asset, it was 5,000 now, and then it accumulated value is now 20,000 rand. When you are claiming it has lost or it has endured damage, the insurer will only pay average of that amount. They will not give you exactly what you need. They will just give you average. So there is also a calculation for under insurance. So you're going to take the amount in which you are insured for, divide it by the market value. Let's say you are insured for 5,000, and then the market value of that item now is 10,000. The 10,000 will go at the bottom, and then you're going to times it by the amount of damage or loss. Okay, that is the formula. Now, example of calculating under insurance applying the average clause. Let's say Menno owns a shared house valued at 2 million. He insured his house with Paloma Insurance for 1,600,000. A fire in the kitchen causes damage of 60,000. So the 60,000 is the damage. Calculate the amount Paloma insurers will pay Menno to cover damages. Show all calculations. So explain to Menno the reason why he did not qualify for full amount of damage. Let's see the portion that was damaged. Melo had an insurance of 1.6 million, and then the value of the house is 2 million, and then the damage is 60,000. So Melo is only going to get 48,000 rand and not 60,000. Okay. And then reason for not qualifying for the full amount of damage is that Meno insured his house for less, which is 1.6 million, than the market value of 2 million. So he was underinsured, so the average clause had to be activated. So he will only receive 48,000 for damages and not the full amount of the claim. So because he was underinsured, that's how we pay. If they say the person was underinsured, that's how you do it. And then there's reinstatement. Reinstatement is a stipulation whereby the insurer may replace lost damaged property instead of reimbursing the insured. So if your car or whatever that you had insured is now damaged, the insurer will just buy whatever that has been damaged. So example is that a business property that has been insured for 300,000, but the market value for the property is 200,000. If it is destroyed by fire, ECT, the insurer will rebuild the property instead of paying cash. And then we have what we call access. is a clause which states that the insured is responsible for a fixed amount of the loss or damage when submitting a claim. So certain portion of the claim is not covered by the insurer. Is an amount that is the amount that the insured agrees to pay in the event of a claim. So here you have a house of a certain value, and I said I can only be able, if this house was to be able to be destroyed, I can only pay this portion. And then there's difference between over insured and under insured. Here they are. Property assets that are under insured are more than their value. Okay, that are over insured are more than their value. And then those that are under insured are properties or assets that are not insured for their full market value. And those are the other differences. And then we have differences between insurance and assurance. Insurance is based on the principle of indemnity. So the insured transfer the cost of potential losses to the insurer at a premium. So I say I am giving the insurance company the responsibility of making sure that my items are secured in case of if something bad happens. But assurance is based on the principle of security and certainty. So the insurer undertakes to pay an agreed sum of money after a certain period has expired on the death of the insured person, whichever occurs first. So specific event is certain, but the time of the event is uncertain. So the difference between insurance and assurance is that assurance, that thing will certainly happen, but we do not know when. But insurance, it covers a specific happen. It covers an event if it may occur. So those are the examples. And now we have 6 examples of short-term insurance and long-term insurance. Now, short-term insurance is property insurance, money in transit, whereby these fidelity vehicles are transporting money. They have short-term insurances. If they get robbed, they can be able to claim. We have theft, burglary, and fire. Those are short-term insurance. And for long-term insurance, we have endowment policies, life cover policy, life insurance, retirement annuity, disability policy, and so forth. And then principles of insurance. We have indemnification. Indemnity usually applies to short-term insurance as the insured is compensated for specified proven harm or loss. So they pay you after verifying that you have certainly endured a loss. So that is the indemnification. Okay, protects the insured against the specific event that may occur. And then we have security. Security applies to a long-term insurance where the insurer undertakes to pay out an agreed upon amount in the event of loss of fire or loss of life. So the insurer gives you the insured the security that they will pay if an unforeseen circumstance takes place. And then we have utmost good faith. Insured must be honest in supplying details when entering into a insurance contract. So that is called utmost good faith. And then we have insurable interest. Insured must prove that he or she will suffer a financial loss if the insured object is damaged, lost, or ceased to exist. Or you must be able to prove with insurable interest, you must be able to prove that you will really suffer if that particular thing is damaged, lost, or ceased to exist. So you can do this activity. We have activity 1 just to see if you understood everything. And this is activity, I will show the answers at the end of this video. And then you can also do activity 2. Just pause the video and do those activities. So you can read the advantages, importance of insurance for businesses. And then meaning of insurable and non-insurable risks. Meaning of insurable risks is that these risks are insured by insurance companies. So insurable risks are risks that the insurance company can risk, and non-insurable risks are risks that the insurance company says no, we cannot insure this type of a thing. So these are the examples of insurable risks and non-insurable risks. And then we have compulsory insurance, as we have said, insurance that is required by law before businesses individual may engage in certain activities. So before you open a factory, you need to register with COIDA, UIF, and RAF. And then difference between compulsory insurance and non-compulsory insurance. Here we have them. I told you what they mean. And then types of compulsory insurance. We did that. Yeah. Now here they are just elaborating them further. Where we types of UIF benefits. Okay, unemployment benefit, illness benefit, maternity benefit, adoption benefit, and then dependence benefit. And then yeah, there we have roads accident fund. And then we have compensation for occupational injuries and diseases act. This one we have done it. Yeah, and then here we have additional revision questions. We are done with this. So let's just see here. Types of compulsory insurance is that the UIF provides benefit to workers who have been working and become unemployed. So UIF is very important, that if an employee has been working and then they certainly lose their job due to illness and other things, they will still be able to claim for 6 months their UIF. So that's why your unemployment insurance fund is important. And then there are types of UIF benefits. Unemployment benefits when you lose your job, when you are sick, when you just had a baby, maternity one, or adoption benefits, whereby employees may receive these benefits if they adopt a child younger than 2 years. And then we have dependence benefit, whereby dependents may apply for these benefits if the breadwinner who has contributed to UIF dies. So those are the benefits. And then for roads accident fund, insurer again insures road users against the negligence of other road users, and then provides compulsory cover for all road users in South Africa, which includes South African businesses. Drivers of business vehicles are indemnified against claims by persons injured in vehicle accident. And then we have compensation fund, COIDA. The fund covers occupational diseases and workplace injuries. So anything bad that might happen in the workplace is covered by COIDA. Compensates employees for injuries and diseases at work. And then we have an additional revision activity here, which you can do. Section A, you can do that. Please don't forget to like, comment, and subscribe. There's also an essay type question. That's the end of the essay type question. And now we have answers to question. Activity 1. We are still on activity 1. Now we have answers. Still one activity 1.3. That was a long activity. Now these are the answers to activity 2. Answers to activity 3. And then answer to the last question 1. and then answers to the essay type question, the introduction, the body, Thank you very much for watching, guys. Until the next one. Oh, this is not the end, so we are still here. And then advantages of insurance to business. And then we have our conclusion. Okay, yeah, that's the end.